The last type of adjusting entry is accrued revenues. Like the accrued expenses, this is where the cash happens later. So we have done some work and someone owes us money because we did that work. Now, typically, when do we actually say someone owes us money? It's when we send out the bill, typically when we do that. Now, there might be a delay in sending out the bill. For example, maybe we are doing work for 2 months and we're going to send out the bill to the client at the end of the 2 months. We're not going to, send bills every 2 weeks or whatever. We just tell the client, hey, we'll do this work and we'll send you the bill when we are all done. Now, when we get to the end of the year, perhaps those 2 months are December and January. And we are going to bill our clients $2,000 for the 2 months worth of work. And again, that would be December and January. All right. Now, our financial statements, we are probably going to be making financial statements on December 31st. So we need to make sure that we capture all of the work that we did in December. Now, this $2,000, well, in December, we probably earned $1,000 of that $2,000. And the other $1,000 is work that we are doing in January. Again, typically, if this is the middle of the year, we're just going to wait until we send the bill to actually record all of this work being done. But since it's the end of the year, we need to make sure we get the $1,000 in December and the other $1,000 belongs in January. So we need to separate it. And assuming we have not recorded this yet, we go through this and we say, hey, our client technically owes us $1,000. I know we said we're not sending the bill until the end of January, but they technically owe us $1,000 for the work that we already did. So if someone owes us money, that's going to be a receivable. So let's do accounts receivable. $1,000. And since we earned this money, this is going to be some sort of revenue. And this is going to be the pattern for all of the accrued revenue journal entries. We are going to credit some sort of asset, typically a receivable, meaning someone owes us money. And we are going to credit a revenue to record the work that we did. All right, just to follow up on this, at the end of January, when we actually send the bill, we're going to send them a bill for $2,000, but we already recorded $1,000 of it in our journal. So we are just going to put another $1,000 into there and make sure that we have $1,000 of service revenue. So this one was done in December. This one was done in January. So it makes sure that the service revenue, the work was recorded in the proper period, in the proper year. Just the tendency here would be to double count everything. So we record this adjusting entry in December, and then we send the bill in January, and the tendency is to say, hey, we sent a $2,000 bill, let's make this $2,000. But that, again, doubled up on the $1,000 that we already put into our ledger. All right, so the important thing for this chapter is being able to recognize this adjusting entry right here, that we debit some sort of receivable and credit some sort of revenue. Again, this is when we do the work before we receive the cash.